Have you ever wondered why a stock suddenly enters the F&O ban list? Or why exchanges put a limit on the total futures and options positions traders can take? And here's an even more interesting question. If stock futures can create delivery problems, then why do index futures like Nifty also have position limits when nobody delivers a Nifty index? By the end of this video, you'll understand market-wide position limit or MWPL. Before we understand MWPL, let's understand the problem it is trying to solve. Imagine a movie theater with only 100 seats, but the management accidentally sells 1000 tickets. Everything looks fine while tickets are being sold. The real problem starts when people arrive at the theater. Now 1000 people want seats, but only 100 seats actually exist. Chaos begins. Arguments start. People are willing to pay extra for the limited seats available. This is exactly what can happen in the stock market if derivative positions become much larger than the actual shares available for trading. And that's where MWPL comes into the picture. Wide position limit. Simply put, it is the maximum number of futures and options positions that all market participants combined can hold in a particular stock. Think of it as a safety limit set by the exchange. Once the total open interest reaches a certain percentage of this limit, restrictions start coming into play. The exchange calculates this limit based on the stock's free float shares. Free float shares are the shares actually available for public trading, not the shares held permanently by promoters. Why? Because only tradable shares matter when it comes to settlement and liquidity. Without any limits, traders start taking massive futures and options positions. Soon, total derivative positions become equivalent to 5 crore shares. Now imagine the problem. Only 1 crore shares exist for trading. But traders have created contracts representing 5 crore shares. Now imagine expiry day arrives. Some participants need shares, some need to settle obligations, some need to cover short positions. Everyone rushes into the market to buy shares, but there simply aren't enough shares available. As demand explodes and supply remains limited, prices can rise abnormally. This situation is called a short squeeze, and it can become extremely dangerous. A few large players can even corner the available shares and force others to buy at inflated prices. Without MWPL, manipulation becomes much easier. Therefore, exchanges say, wait a minute, you cannot create unlimited derivative exposure when the actual number of shares is limited. That's why MWPL exists. Now comes the famous F&O ban list. When open interest reaches 95% of the market-wide position limit, the stock enters the F&O ban period. What does that mean? No fresh positions can be created, you can only reduce existing positions. The exchange essentially says, too many contracts have already been created. Let's cool things down before risks increase further. Once open interest falls below the prescribed level, the stock is removed from the ban list. Now here's the question many traders ask. If MWPL exists because of delivery issues, then why do Nifty and Bank Nifty also have position limits? After all, nobody delivers a Nifty index. Great question. Let's first understand how index futures are settled. Suppose you buy Nifty futures at 25,000 and on expiry, Nifty closes at 25,200. You simply receive the profit difference in cash. No shares are delivered. Similarly, if Nifty falls, the loss is settled in cash. This is called cash settlement. So yes, there is no delivery risk in index derivatives, but there is another risk. Let's summarize the difference. For stock derivatives, the concern is whether enough shares exist. However, for index derivatives, the concern is whether participants can handle the financial exposure. MWPL protects against delivery shortages and market manipulation, whereas index position limits protect against excessive financial risk. The biggest mistake traders make is thinking that MWPL is a bullish or bearish indicator. It's neither. MWPL simply tells us how much of the allowed derivative exposure has already been utilized. When MWPL rises, it means participation is increasing. But to understand what smart money is actually doing, you must combine MWPL with price movement, open interest, volume, and market structure. That's where the real edge lies. If this video helped you finally understand MWPL, F&O ban, delivery risk, and why index futures also have position limits, then hit the like button. Subscribe to the channel because we simplify complex stock market concepts into practical knowledge you can actually use. Thanks for watching, and I'll see you in the next one.